The following program was produced by an independent community producer. The opinions expressed do not necessarily reflect those of the QATV staff or board of directors. QATV, in compliance with FCC regulations, is prohibited from exercising control over the content of independent, member-produced public access programming.
Hello everyone and welcome to another edition of Tom Williams' long-running TV show Sound Advice. My name is attorney John Duane of Hoye and Duane, located in the same building as Tom's office at 21 McGrath Highway in Quincy. And today with me is Miss Deb Colanino from Shamrock Home Loans. And we are here to talk about where the rates are and whether it may make sense for you folks to consider a refinance. The rates are at historic lows. I've been in this business for about 18 or 20 years, and I have never seen the 30-year rate where it is today, or where it has been this week. While we can't really quote specific rates because every situation is different, just know that we're in a historically low rate market, and we're going to talk a little bit about today about maybe some of the most likely scenarios that people may consider refinancing. So, Deb, thank you for being here today.
Thank you.
And how long have you been in the business?
I was in real estate back in the day of 1985 and stayed as a realtor for about 15 years, took a little hiatus and came back in on the mortgage ends in 2005. So it's been over 30 years that I've been doing real estate and mortgages.
And I would guess you probably haven't seen the rates lower than where they've been lately.
No, even in the economic crash that we had in 2008, they really didn't quite get down to where they are. We're just a tad lower than where we were then. And I honestly can say that it's a rare opportunity, and people should take advantage of it if they possibly can.
So who are the most likely candidates that have been calling you in the past few days to see whether they're good for a refinance?
Well, the reality of it is if you've had your mortgage for more than 6 or 8 months, you may benefit from a refi right now. Even if people say, well, I just bought my house and I just financed it, but I have people that I just refinanced last week that bought their house back in August, and they were, not August, yeah, August they closed, and they were able to drop their rate from 4.25% to 3.375%.
I know there are a lot of folks out there, especially in this area of the world where house prices are so expensive, that may have borrowed 90 or 95% to make a recent purchase of a home. And when I say recent, I mean 2, 3, 4, 5 in the last 2, 3, 4, 5 years. That may be paying PMI. Can you explain to the audience what PMI is in general terms, and then maybe see how a refi might be able to help some of those folks out?
Right. If you buy a house without 20% down payment, they have a program. It's called private mortgage insurance. And what that does is it allows you to buy the house with less than 20% down. And some programs will go as high as you could put only 3% down. 5% down is pretty common with a conventional loan. FHA is 3.5%. If you have a conventional loan and you put less than 20% down and you have monthly mortgage insurance on your current loan, it's entirely possible that if you bought it within the last, more than 24 months ago, you may actually have enough equity in the house to eliminate that monthly mortgage insurance and also lower your rate at the same time.
Right. Or if you were in a situation where you had a really good rate and you didn't want to refi to get rid of the PMI because you were afraid to lose the rate, well, now may be the time to pull the trigger on that.
Right, so you'd be able to
move.
maintain that really good rate and get rid of your monthly mortgage insurance. It really depends on the equity that's in the house, how long you've been there. It still depends on your credit score. Your credit score still drives your interest rate. That's the first thing we look at, is what is your credit score, to help us determine what your interest rate is.
Well, that brings up a good point, Deb. I think most folks are aware that there's going to be a credit part of the application. What are some of the other documents that the borrowers or buyers should have handy when they get ready to call their loan officer?
Right. If you want to call your loan officer and find out if you're eligible or if it's a good idea for you to refinance, the first thing you should have in front of you is your most recent mortgage statement that you get in the mail every month, that shows how much your current payment is, what your tax escrows are, what your homeowner's insurance escrows are. You should also have a copy of your tax bill and your homeowner's insurance policy. That's the declaration page that says how much it costs you for your annual policy. Because that's all information that the loan officer needs in order to determine what we can do for you, as to if we can do better than what you already have, and determine, if it's worth the expense of paying closing costs to refinance, and how long it would take to compensate, how much of a savings you would have to compensate for paying a few $1,000s in closing costs. Keep in mind, though, those closing costs can be rolled into the loan amount, so you don't have to come up with any money out of pocket.
That's right.
In most cases.
Yeah, and again, in most cases, you can decide whether you would like to write a check to pay for some of the costs, or roll it into the loan, or maybe even a combination of both. Yep. So there are probably some of you out there who have, whether it's school loans, but maybe more specifically, credit card debt. If there is any interest in lowering that monthly outlay, because it seems to me that the most important number to folks these days is what is everything costing me on a monthly basis.
Yep.
So if there's a good segment of the population out there that could probably benefit by a refi that would include paying off some of those credit cards. And I've noticed in the past that sometimes it seems that it's a bank requirement that the credit cards be paid off, and sometimes the people can use the cash out from a refinance to pay whichever cards they'd like.
Right. The one thing, a lot of people get really nervous when you say debt consolidation and borrow against your house for that. Back in pre-2008, people were doing that, and they would allow you to borrow up to like 95% of the value of your home. You can't do that anymore. Right. So we've put in some buffers that will not allow you to get into trouble where you're using up all of the equity in your house. So the maximum amount you can borrow if you're taking cash out of the equity in your home is 80% of the loan to value of the property. So if your house was worth $100,000 and you could borrow up to $80,000, and if you had a $50,000 mortgage, that would mean you'd have $30,000 that you could work with to pay off some debt. That's just a round number, obviously.
Right. And so when you add to that scenario, maybe the passage of time from when you bought the home till now, I haven't found too many places around here that haven't been appreciating at a pretty good clip in the past few years. So you may be pleasantly surprised to see what the lack of inventory and the incredibly high buyer demand has done to the price of homes around here. It's, I'm in the business, and it continues to, and probably may even, surprise us sometimes, though, especially in some of these smaller South Shore towns where you look at the inventory of homes on the market, and there may only be 10 homes for sale. And that's through all price ranges. I don't mean just in the price range that you want. I mean 10 homes for sale in the whole town. So with that said, you need to, as a buyer, need to be able to make your offer as strong as you possibly can, all things being equal. We know typically that price, is usually the most important thing to a seller, but a buyer is smart to have, either on their own or to have their buyer agent find out what else is important to the seller. It may be that the seller wants to be out of town in 3 weeks. It may be that the seller wants to stay in town until the end of school. And if you don't know that simple little piece of information, your high bid may not win. So those are some practical things that you can talk through with your realtor. But what I do try and stress to especially first-time home buyers and any home buyers, is that The strength of your pre-approval letter goes a long way with experienced agents. And when you have loan officers that are familiar in the market, that goes a long way with the local real estate agents. So all the more reason to take another look at your pre-approval letter. Make sure that you don't have stale information on there. Again, if you're looking at homes with a pre-approval letter that you got 4 to 6 months ago, or really even shorter than that, it may be stale to some extent, right? So how are you handling situations where you've had, I know you, like any loan officer, there's a lot of pre-approvals out there and buyers looking for homes.
Yeah.
Are you having a lot of calls from folks that are looking to check in on their pre-approval letter?
Well, how I do it is I require my clients to, when they're submitting an offer on a property, they need to call me. We review the numbers. We make sure the numbers work for them, and payment-wise, down payment-wise, taxes, because every property is different. So the taxes on one property, the property price might be the same as this property over here, but the taxes are that much higher, so their payment's going to be different. And while they may qualify for this property, they may not qualify for that one because of the taxes. So every time they go to submit an offer, I have them call me, I run the numbers, and then I send them and their realtor a pre-approval that is custom made for the offer they're making, so that it's up to date. They know exactly that they definitely qualify still, even if rates have fluctuated in some way. Mm-hmm. And the seller knows that it's a current basis. It's based on current market, current value, current income.
Currently dated even.
Currently dated. It's dated for the date that you get it. It's good for 90 days, but all you have to do is re-up your credit report after 90 days. Constantly send me your pay stubs and your bank statements, and that's pretty much all you have to do to keep it current. But that's how I prefer to do it, and having done this for such a long time, what that also does is it gives you, the buyer, the advantage that if the property is listed at $350 and there's multiple bids going in on that property, we can talk about that, and I can say to you, well, you do qualify to $360. So if you want to bid up on that property and make sure that of the 5 bids that are going in on that property, yours is the highest and best bid, then I will give you a pre-approval for that amount. So that's important when you're getting a pre-approval, is that you know what your top dollar amount is.
Right.
And if you are pre-approved, say you're pre-approved up to a $375 purchase price, look at properties that are on for $360 and $365, because in that price range, they are getting multiple offers, and you will wind up, in order to win the bid, you will wind up having to go over asking price on most properties in that price range in today's market.
Right, and if you say, well, I'm approved for $375, I'm aiming at $375 and no lower, you're probably going to be setting yourself up for heartbreak, because again, as Deb said, almost any house that's listed reasonably in that price range is going to go quickly. So all the more reason to get ahead of it. I know that you can do, as a first-time home buyer, obviously a lot of your research is done online as far as finding homes and things like that, but you're putting the cart before the horse. You need to know how much you can afford before you go looking for that home. And in my experience, if you want to be ready to pounce on a home that you really like, I think you really need to be able be in a position to make an offer within 24 hours of seeing that property.
Absolutely.
And that's from the attorney, not from the realtor or the loan officer. I do see that in many markets that are operating.
What a lot of realtors are doing now is, when the property first comes on the market, they'll hold an open house. So they'll list the property on a Thursday, and they'll say no showings until Saturday or Sunday's open house, and then all bids have to be in by Monday at 5 p.m. So that means that everybody who goes to the open house on Saturday and Sunday, sometimes both days, everybody who wants to bid on that house, all their bids go in at the same time and get presented to the seller at the same time. And that's a very common practice right now.
Right. So your offer needs to shine.
Yeah.
And, again, you need to know what's important to the seller, and you need to have a strong pre-approval letter, and you have to have that all wrapped up and ready to go in a matter of hours. So I hope we didn't scare you too much about the home buying process, but what I do want to recommend is that you talk to your loan officer sooner rather than later, because we talk about this all the time. It seems for those of us in the industry, there are many myths out there about, well, I'll never be able to buy a home, or I'll never be able to refinance because of this, that, or the other thing. And we could list off the top three, right? Either my credit's not good enough, I can't afford the payment, they're never going to lend me that much money. You'd be surprised. And again, everything is situation dependent. If you're a little deficient in one category, typically you have to be a little bit better in one of the others. And what categories am I talking about? Those would be like down payment, credit, and then ability to repay.
Yep.
Right? So obviously you really do have to show the ability to repay. What are the most common forms that the bank requires as far as that goes?
In order to document your income, and this is important because I know a lot of the clients that I'm seeing right now, they work sometimes 2 jobs, each of them, the husband and wife, each work 2 jobs, and I can use second job income, but you have to have been at a second job for at least 2 years.
Okay.
All right, so it's important to know, what dates you started at your job, and what your, if you have job A, that's your full-time job, and then you work job B on the weekends. I can do both of that, but I need pay stubs. I need 30 days most recent pay stubs from all forms of employment, and I need W-2s from your current year, so like from 2019 and then from 2018. So we need 2 years worth of W-2s and 2 years worth of tax returns. Right now, if you haven't done your taxes yet, we would go with the 2018 and then your W-2. But generally speaking, anytime after April 15th, you're going to need a tax return to basically verify that your income is real and solid. We will send a form to your employer that we have them confirm, fill out the form, tell us what your start date was, what your pay rate is. So we do confirm all of that with your employer. So, jobs, you obviously have to be being paid over the table and paying taxes on them.
Right.
You do need a 2-year work history, but that doesn't mean a 2-year on the same job history. If you are a nurse, and you've only been on the job for a year here, and you move to another hospital doing the same thing, you've been there for a year, so you've got 2 years worth of work history. They don't want to see a gap. So if you go from one job to another, if you're out of work for more than a month, then the clock starts ticking again. So if you're out of work for more than 30 days, then the 2-year thing starts to tick on you again.
And no such luck calling it a vacation or anything like that. No.
Yeah. Once in a while, I've been able to have someone. I had a gentleman who had to go take care of his elderly mother. He took a month off, went to South Carolina, took care of her, and then came back and went right back to his job. All right, but that's a whole different. You have to get a letter of explanation, things like that.
And and that kind of shows how deep sometimes they have to get in. That the underwriters will get into a file and some of the explanations that have to go along with the file. And again, if you think you have a ding in your credit profile or whatever it may be, all the more reason to start the process sooner rather than later. We've talked about some of the issues that home buyers should be aware of. With refis, how is the process, most people think, oh gosh, the process is going to take forever. It's going to be this big overbearing thing. But with people already having all of their tax information pretty much at hand, or pretty close to being able to have it at hand at this point, if the borrower has all their ducks in a row, what's the normal turnaround time, let's say, from application to close? From
application to close, depending, it could do 30 days. Generally speaking, we try for 45 so that it's not a rush, stressful situation. And we do have to rely on the appraiser to get to the property, appraise the value of the property, and then get back to us. So we've had a little bit of a backup with that. So I generally try to tell people 45 days.
And I correct me if I'm wrong, but there are some situations where you may not even need an appraisal.
Exactly. If you're not taking cash out and you're just doing a rate and term, I have a client right now who has a 30-year loan, wants to knock it to a 15-year loan. So he's got enough equity in the house. He's had the house for over 10 years, and he doesn't need to have an appraisal. So that one we can close in 30 days with no issue.
Because that kind of leads into the cost part of this too.
Yes.
Because in my experience, usually the first kind of hard cost on a refinance or a purchase is the appraisal. And so, is there any cost for a homeowner to talk to their local loan officer
No,
to get started?
information is completely free. And really, we don't take any money up front at all until you actually decide to move forward. You sign all of the government mandated disclosure documents, at which time we will collect the appraisal fee if we need one. If we don't need one, then there's no money out of pocket on that.
And again, correct me if I'm wrong, but it may not even require an in-person appointment.
No, we can do all that online. Nope. It's very easy to do DocuSign online now.
Yeah, that's what I found. I think, and I'm just guessing here because I've never been a loan officer, but I'm guessing that one of the more difficult parts of the job was collecting the voluminous information you need from homeowners who are busy doing whatever they need to do.
Yep.
So, and getting them to sign disclosures.
Yep.
So that process has become as easy as you can imagine. So what used to take weeks and multiple meetings to sign forms can now be done with the click of the mouse and really be done in a matter of minutes.
You can actually do it on a phone app now. We have a phone app that you can actually download your documents. You take a picture, it goes into the phone, goes right into our system.
I don't doubt it.
There's all kinds of handy dandy ways. And if you're not tech savvy and you say to yourself, well, I'm in the AARP crowd that doesn't really know how to do all that stuff.
Yes.
We're more than happy to do a face-to-face appointment. And most loan officers will say, all right, put them in the mail. It's still, snail mail still works. So there's lots of different options. So don't let the technology aspect of it frighten you, because there are people who are a little standoffish on that.
I find the same thing with my clients, and they're either completely one way or completely the other. There's no real middle ground. It's either give me hard copies and paper documents, or put it on a disc, or I'm not even going to keep it. So there is really no in between.
Nope.
So another segment of the population out there that I just wanted to make sure we spoke to was those folks who may have an equity line on the home that they took out in the last 10 years, whether or not it's gone into repayment. If you have any ideas of paying that off, it could be a good idea to bundle that with the first mortgage financing. And are there any complications or kinks to that process that the audience needs to be aware of? Or
technically what that becomes is a cash out refi, because you used the first mortgage when you bought the house, and then you took the home equity line of credit afterwards, so you're actually taking equity out of the house. So you took cash out, and if you're going to pay it off, you're taking cash out again to pay that off.
Yes.
Again, you can only go up to 80% of the value of the property, so you have to make sure that you have enough equity in it. There's a couple of ways that you can determine what the equity of your property is. You can look online and look for similar properties that have sold in your area, but generally speaking, your loan officer should be able to help you with that as well. So when you talk to your loan officer, they're going to ask you, well, what do you think your property's worth? Give them your opinion, but generally speaking, when I do that, I usually will do a little research on the multiple listing service, and I will look on various other sites to see and confirm that I think your property is probably worth about this much, so we should be safe with the 80% loan to value.
And I was going to say, I bet you the houses wind up being worth about 80% of what the homeowners think it's worth, but that's a story.
Yeah, that can be an issue. Don't overvaluate your property in your mind, because you're not going to help yourself that way.
And the same conversations that listing agents, I'm sure, have with their sellers.
Yes.
I'm sure that's
listen to the professionals.
That's right.
They do this every day, and they're looking out for your best interest, because if you overstretch your expectations, they will not be met.
That's right, and the professionals in the business, you do rely on them to a certain extent, and the professionals you should choose them because they've been doing a great job at that line of work for a period of time, and they're not going anywhere. That's a good way to pick who you want to do business with. So we've hit on a lot of topics today. I hope we have kept it at a good level for the audience. I know sometimes we have a tendency to get into the higher level topics. So some of the myths about credit. I know it is a very counterintuitive process. If somebody 15 years ago told me or asked me, what do you think the best way to fix your credit, I would say, all right, close all my credit cards and have no credit, right? Then
I don't know anybody.
Very credit worthy, right? All I have is income, no debt. So I've learned over the course of years that is very far from the truth, and that there are a lot of little, I don't want to say tricks, but there are ways you can understand the system and use it to your advantage in a way that'll make your credit score go up. So without going into all of your the ways you can help people,
I could give a whole hour seminar just on that.
I believe it. I believe it, because it is a process, like everything else these days, it's based on an algorithm, and if you know it well enough, you can use it to your advantage. And let's take paying your credit cards down to zero and closing them out. Good idea or bad idea?
Bad idea.
Right. Almost
idea.
Across the board. Again,
across the board, bad idea.
Situation dependent usually. But
yeah, situationally. Basically, when you're going to if you're trying to get your credit good for a mortgage, what the requirements are is 3 open and active credit lines of credit. What they like to see is like a car loan, a major credit card, and maybe like a Kohl's or a Target or JCPenney, Home Depot, those type of cards. That's what they want to see at a minimum. And they want to see that you make your payments on time. It's called fiscal responsibility. They also want to see that you don't use 100% of your available credit. You're actually better off having 3 credit cards that you have only run to half of your available credit than you are having one run all the way to the max.
Right.
So, 3 lines of credit, and the rule of thumb is never use more than 50% of what they give you for available credit. If you have a line of credit for $1,000 on a credit card, never ever use more than $500. Use the $500, pay it down in increments. Now, if your minimum payment is $30, pay $40 and pay it down till you get to zero. You can pay it back and then charge again. Never go higher than $500 and pay it down a little bit at a time. That is the fastest and easiest way to get your credit score to go up.
So hopefully, the audience will take this to heart, and they'll be running around all the local merchants in Quincy asking for
credit card
credit applications. So these are all good tips, and just kind of the tip of the iceberg, not to have a pun here, but as far as the wealth of information that your loan officer has about the process of qualifying and getting approved for a loan. And I know that some buyers out there are concerned that the price of houses has seemingly gone out of reach, but the rates becoming lower gives you that much more purchasing power. And the rates have gotten to such a low level that my old rule of thumb really isn't working anymore. When you're around 5% for rates, for every $100,000 you borrow, you pay back about $500 a month. But now the rates are so much lower that it's better than that, but I'm not even sure how much better. So that just gives you a really, really rough idea of, if you're taking on a $300,000 mortgage, what you could expect to pay back roughly. And that's before you then take into account the local taxes and your homeowner's insurance. But the tax idea you bring up is a very important thing. You take the same house in 3 different towns, it could be $2,000 in annual taxes in one town. It could be $10,000 or $12,000 for the same house in a different town. So thank you very much to the audience for playing today. We appreciate you watching and listening. And thank you very much to Deborah Colanino from Shamrock Home Loans. Thanks again, and we'll see you next week.